Welcome back. The Nifty is down about 18 points at the low point of the morning actually right now, and the Bank Nifty as well, dragging the Nifty. The Bank Nifty down about 100 points. We had a really bad fall yesterday. Has this shaken confidence in retail investors who have invested all through 2015? We got a big guest now, Anand Radhakrishnan, Chief Investment Officer at Franklin Templeton Investment, now joins in. Anand, good morning. Always good to have you, but even better to have you, on a day like this. What's your reading of what happened yesterday? And do you think days like yesterday can shake off the confidence in equity markets, especially for retail investors who have been a bit of a pillar of strength for the market over the last 1 year?
What happened yesterday was because of the contagion from the China markets, which we all know. And it had a very specific reason why the markets opened less, because of two factors. One was the incoming data point was not very great on the PMI side, plus the time period for the short sale ban was coming to an end, and therefore it was feared that fresh shorts will be created and because of that there was some bit of a rub-off effect on India. But I don't think from an Indian investor perspective anything data point wise anything incrementally bad happened. It was just a regional rub-off which eventually is kind of cooled off a little bit now. So I don't see therefore a big contagion kind of an impact because of this one-off effect.
But impact on retail sentiment, which was my second question.
We have had fresh positive flows yesterday, if I can.
No, yesterday's one up. What I'm saying is that if we have this kind of trend over the next 2 or 3 months, where we see equities worldwide, become a bit of a hated word, in that case, what happens to that money?
It is going to be a bit challenging. It is not. I won't be able to say conclusively one way or other that investors won't be perturbed or will be perturbed. Depends on how things pan out. But the time period is also very important. How quickly it takes place, or how long it takes to kind of this correction or this challenging environment continues. For example, people who have invested in Indian market 6 months back may not be having a meaningful return 6 months by now, but it's only 6 months, so they may be willing to continue their systematic investment plans, or further allocation they may be willing to make. Maybe they themselves, when they started with small amounts and they are kind of averaging it as it goes down. But if it kind of continues for another 6 more months, and then the doubts will start coming in, and which might kind of slow down the further inflows into the market. So it's kind of too early to say that whether the investor sentiments is going to be impacted because of what happened over the last 5-6 months.
But do you think that we could see more investment by retail investors in other asset classes in 2016 as opposed to 2015? Say the likes of real estate, say the likes of maybe even commodities, because a bounce back is expected this year. Your sense?
Incrementally, some money can move into other liquid forms of assets, I would put it.
Fixed income.
Liquid forms of assets is how I would put it. Maybe fixed income, because the yields have again gone up a little bit. Maybe gold, ETFs, and maybe a little bit of commodity-based funds or exchanges. They can play for a bounce back. Real estate would be a little bit tough because it's illiquid, and price correction is not as high as it is in the other asset classes. If you look at the gold prices or commodity prices or fixed income prices, all of them have meaningfully corrected. We are yet to see that meaningful correction in the real estate thing, at least going by what is published prices. But if prices do correct, people might reallocate, but I don't think the probability of that happening in 2016 is high.
Okay. Anand, let's talk about the overall market scenario now. The two big sectors, banks and IT, they are not providing leadership to this market. Even in your funds, there's quite a bit of allocation, as you would expect, with the kind of weight that they have in the index. Where do you see the market will get leadership at the index level, which is something which the market hasn't got all through last year?
If you look at broad index, the earnings for the current year is expected to be 9.5% growth. Next year, of course, the growth is pretty high because of the low base effect. But this year alone, if you look at 9.5-10% growth of the index earnings, most banks, private sector banks, probably would beat it. and many IT companies also in rupee terms will probably beat that earnings growth. So actually it is not therefore factually fully right to say that they don't have earnings higher than the average. They actually have the earnings, but if you have public sector banks and other kind of things added to it, it pulls down the average. But as a sector as a whole, private sector banks and IT companies will probably have earnings growth better than the average market, considering where the average is today. Average has come down a lot, average earnings growth. Next year might be challenging because next year average expectation is pretty high. Growth expectation is still 19.5% kind of a growth. Will IT sector will match up to that kind of a growth is, I don't think it's going to be easy for them. So earnings growth wise, they may not be providing the leadership role, but their valuations are not very high. So the stock returns may not be necessarily because of earnings growth alone. It's a combination of earnings growth versus where the starting valuations are, and there I don't see the valuations to be too challenging in the IT sector.
Okay. Well, I can't help but ask this question because you have a Franklin India Pharma fund and your blue chip fund has Dr. Reddy's as one of its core holdings. I don't know if you've already trimmed positions on that one or what the allocation stands at right now. But obviously, the last year has been plagued by US FDA issues for multiple top blue chip pharma companies. How do you evade the risk of the US FDA? Do you just stay put on your holdings and wait it out for the next 2 to 3 years? How does it work?
The sector is going through this particular challenge of moving up the value chain. Moving up the value chain involves upgradation of all the processes and systems and your practices. And where we have had serious challenges last year when US FDA intervened and issued warning letters. We view this as a natural progress of the industry. If the companies want to go and do more complex products, if you are manufacturing oral solids, you need to have certain kind of systems. If you want to do injectables, you need to do better things. You need to have more sterile situation, more better practices in the manufacturing thing, because that's more profitable area to be in. So I think the consequence of moving up the value chain is this. Is the need to upgrade the systems and processes, and we view that actually a positive development because it will make these companies adopt better standards and practices over a period of time. And in the meantime, if the markets seem to be disappointed with that, I would look at that as an opportunity.
Okay, fairly large exposure to autos as well for you. Is that going to be one of the preferred sectors in 2016 as well? We've seen a couple of stocks do remarkably well, like Maruti, for example, has done phenomenally well. But we have seen a couple of stocks drag as well. Tata Motors, of course, a case in point. So this is, of course, stock-specific story. But overall, how would you approach autos?
The domestic autos still are very best positioned for a good cyclical recovery. The discretionary spending coming back. Because of rising income, falling inflation, falling interest rates, whatever way you can do it. So the domestic automobiles, whether it is domestic car manufacturers or two-wheeler manufacturers, are all well positioned for a reasonable growth. They have capacities, they have the costs already embedded in. Some of the raw material costs are also falling. The steel, the aluminum, the rubber prices, all of them are falling. So they have a tailwind in terms of margins. So last year, despite all the challenges, even in two-wheeler sectors, many of the stocks did pretty okay after the initial correction. So we continue to remain. It's probably the easiest way to pay the discretionary spending coming back in the economy. Tata Motors is, of course, a unique case of it's more a global firm than an Indian company.
Okay. I just wanted a broader market question or answer from you. What is the biggest risk you think poses for equities in 2016? Would it be China, which we've already discussed, or say, for example, the GST not being passed in 2016 as well, or would it be something completely untoward, say oil prices bouncing back because of what's happening in terms of the geopolitical tensions in West Asia, and if that escalates to any different level?
Risks can be many. I mean, typically they are not unidimensional, they are
most prominent
multidimensional.
risk.
So many of the things which you mentioned are potential risks, but for the market's perspective, not necessarily from the economy is very resilient. I think it's not going to be very volatile in terms of growth or degrowth or whatever it is. The market requires a reasonably favorable global equity environment for the equity markets to do well, which can be challenging because even developed countries' markets, after having US, Europe, after having a massive run for last 3, 4, 5 years, are getting tired a little bit. So that doesn't provide you a very great backdrop for any market to have a runaway kind of a performance. If you look at the last 20 years, Indian markets have always done very well only when the global markets are supportive. They don't have to be doing very well, but they need to be supportive. So whether that situation is going to be there is a bit of a doubt. It's a reasonable risk. Commodities bouncing back is another risk which you mentioned, especially the oil. But I think markets are not fully pricing in $35 either. Market, if you really think about it, I think the markets are probably pricing only about $50 in terms of the ultimate benefit. So I think up to a point in terms of recovery in oil prices, I don't think Indian markets are going to be that much impacted fundamentally from a commodity bounce back. But you can take it with some level of certainty that certain commodities are definitely going to bounce back.
Okay, so Anand, with so much global risk, as you spoke about as well, do you think our market needs to adjust the valuation multiple a bit from the current 15-16 times or whatever we're trading right now to a slightly lower level to factor in all the global risks?
Aggregate market valuation is a very tough call.
I agree.
It's an average of 30 or 50 companies, and sometimes it can be 500 companies. So to take a view on that will be tough. We as fund managers can take individual stock view and can see how low the valuation can go. But typically the low valuation of one stock need not have to be coinciding with the low valuation of 30 stocks. If you put low PE for all the 30 stocks, then historically whichever way they have ever achieved, then the index PE will be very low. But that never happens. When a low PE of some stock happens, some other stock trades at a very reasonable PE.
Okay, so let me ask a different question then. Last year we saw the market was willing to pay premium for quality, and the expensive stocks kept getting more expensive and the cheaper stocks kept getting cheaper. This year, do you think value will catch up, or will it still remain quality stocks at expensive valuation?
It's quite possible that rotation will happen in the current year, and I think the premium which the market was paying for growth has kind of reached levels which may be tough to sustain, and market might cycle towards value probably as early as in the first half itself, but it can happen at any point of time. And it can be triggered by a bounce back of a corrective bounce back of commodity prices. It can be triggered by some macroeconomic development within India. So it may be a good strategy therefore to follow a blended approach of growth and value rather than being pure growth at this point of time.
Okay, just a quick last question from me, Anand. Bharti Airtel is also part of your portfolio. We already have the call drop issue that we're going to have to deal with. We'll hear more about it tomorrow as well. But we also have impending competition from a big stalwart such as Jio, which is coming in. Your sense in terms of how telecom is going to look in 2016 fundamentally, as well as Bharti Airtel, why do you like it?
I think the sector is poised for significant consolidation. It is going through consolidation already. I think it will be poised for more consolidation. And with the entry of a new player, I think luckily the launch was getting delayed, and that has given a lot of breathing space for existing players to at least get their act together. So many of them have rolled out their 4G networks, the LTE networks, which are as efficient as what is going to be an incoming network. So had it happened a year back, this would have taken some market share quickly away from the incumbents, but that's going to be challenging for the new entrant to take the market share. Parallelly, we are seeing consolidation of existing players trying to either exit or partially merge with the other existing players, and we see that as a very conducive environment for the top two, three players to become more profitable. But this is going to take time. It's not going to happen overnight, and there are challenges. So, but our constructive view on the sector is in spite of the fact of an impending competition. On the other issue of call drop and the thing, it is a fact that the incumbents had not invested adequately in the infrastructure which provided very high quality voice and data networks. I don't think they had done that for various reasons, because competitive pressures have pushed the profitability of the industry low. They didn't have enough cash flows to go and invest in high technology and providing the high class networks. So I think now with the consolidation, it is giving more cash flows to the incumbents to improve the quality of the networks. So it will be a non-issue after a couple of years, is how I would look at that.
Okay, one final quick question then, Anand. It could be, a bit tough to ask a fund manager this, but in the year 2016, what is the probability that the market will reclaim its previous high, or do you think it will be too tough an ask to, go back to the previous highs? The underlying corporate growth trends are very important to get to any new highs. And if I look at if I slice and dice the corporate profitability of the top 500 companies, the one trend which is coming out is that the number of companies which are reaching new high in terms of profits is going up. If 5 years back 90 companies were generating new high in terms of profits, today it's probably 220 companies whose profit in 2016 will be their life high profits. So this breadth of new high in terms of profitability is increasing, and that's a very healthy trend. If you, despite all the macroeconomic challenges that we have, so we as a bottom-up investor have to only look at such trends to see as to is the market is in a safe trajectory from a medium to longer term perspective, and I think it is there. Whether it scales a new high as an index level or not is a bit of a speculation. Fair enough, Anand. Thanks a lot for your time, and thanks a lot for coming to our studios. So that's the view from Franklin. They remain constructive on the companies and on stock markets, but aggregate level may be a bit tough to call. Let's take a break on that note, but up next we'll get you some commodity strategy.